If you're like most people, you've been talking about inflation a lot. In today's video, we're going to talk about how inflation impacts your retirement and some of the best concepts of how to hedge inflation when heading into retirement. Hello everyone, thanks for stopping by the Financial Beat YouTube channel. As always, here to bring you another great video and some insight on some retirement education. So today's video, we're going to talk about inflation. For those of you that haven't, you actually can head over to our video library and check out some of the other videos we've done. And we actually have a part one of this video that we did a few months back in regards to how inflation impacts retirement. This video, I kind of wanted to expand upon that one and really talk about some of the big concepts that are out there. Number one, starting with what causes inflation. This might to you, some of you sound like a duh moment, right? But basically what inflation is, right, is the cost of goods and services continuing to rise, right? Typically, historically, when you look back, you can see inflation anywhere from 2.5% to 3.5%, depending on which chart you read, but that is typically a historical inflationary period. Right now, over the last few years, we've been going through a time where inflation has been rather high. Some think it's underreported or overreported, depending on what side of the fence you lie. But either way, we all can agree that inflation has definitely been around this last few years, and the cost of goods and services have risen to reflect that. As well as when you look at cost of goods and services, you also look at employment, right? When you look at the cost to get a worker nowadays is typically a lot higher just due to the lack of people out there applying for those jobs, as well as creating a competitive market out there. So it's causing a lot of people that are applying for these positions to get a higher salary, right? Which is also an inflationary period. So there's a lot of different impacts also when you're looking at like lumber, housing, all the other stuff that's factored in over these last few years. But it's really caused a lot of goods and services and things that we all buy to increase, which what that really translates to, it means that our money now buys less, right? So a dollar today bought less than it did a couple years ago, right? Or even a few months ago. So it's something to really consider. In today's video, I wanted to discuss the impacts of it on retirement. Obviously, we know that when you're heading into retirement, a lot of us go into retirement with somewhat of a fixed income. What that would mean is, right, we have $3,000 or $4,000 a month or $5,000 a month coming in, and that might be our retirement based off Social Security and pensions. Well, a lot of those do have some cost of living adjustments to them, but they're typically not as high and don't keep up with it as fast as we would have liked. Of course, last year, Social Security gave a pretty good raise to a lot of you guys out there on it. Number one, we like to look at asset location, right? Asset allocation, wherever you want to talk about how your assets are structured. Now, there's obviously some investments out there that tend to be a very good spot to be during inflationary times historically. Historically speaking, stocks, mutual funds, ETFs, any types of market money have historically been a good spot to hedge inflation over a long period of time. Now, with that being said, obviously there is volatility with those, so you want to make sure you're looking at your risk and all that stuff before going into those investments. But historically, stocks, real estate, REITs, mutual funds, ETFs, like I mentioned, equity funds, some bond funds in the past have been good spots to historically outperform inflation. Now, those spots are typically, like I was saying, you're looking for a decent return over a period of time to somewhat keep up with inflation. And again, historically, those have done that. But of course, right now we have a lot of other things going on. So it's very important, again, when looking at those investments to really look at your risk and make sure you're in the right one for what you're trying to do and not just necessarily chasing return to try to combat inflation. You really want to be mindful of that. The other thing you want to look at is there's some asset classes that are historically bad at combating inflation, right? Cash has been a killer. I did some ones in our other video in regards to how it shows the impact of your dollar going down pretty dramatically. And I have a lot of clients tell me, well, I like cash because it doesn't lose any money, right? Well, that's true to an extent, but it's also not true to an extent, meaning that, each time we have $100,000 in the savings account, let's say, and we have a 9.1% inflationary period like they're reporting this year so far, that means that no matter what we think or not, our dollar, our $100,000 now buys essentially 9% less this year, right? Or lost 9% of its buying power. Now, one of the things I'll tell you for those of you that are going into retirement or maybe just retired, it's very important to look at your risk tolerance and what your goal is with money. I'm a big believer in having money in cash. It's a good spot to have safe emergency funds. Maybe you're buying a house in 6 months, or maybe you're buying a house in a year, so you wanted to have some extra money there. that's okay, but we want to make sure we're not keeping too much in cash because, again, during this current time, inflation is really, really hurting those dollars. And with interest rates rising, right, to combat, the Fed's trying to combat some of this inflation in their own way, isn't always necessarily a bad thing. There is a lot of things out there like CDs, money markets, fixed annuities, fixed index annuities that are positively affected by interest rates going up, means that they're typically paying a more competitive rate of return. We have seen fixed annuities, which for those of you that don't know, it's basically like a CD on steroids. In most cases, they're typically a CD, but they pay a little bit better of an interest rate on them historically. Fixed index annuities are tied to the market gains, but you don't get the market losses depending on which annuities you're using. Those have all seen huge increases in rates, and the returns are a lot more competitive, a lot more where me and you would both like them to see, as well as you're seeing banking and things of that sort starting to raise those slowly. So there is some opportunities out there to look at those. If you have questions on that, make sure you're giving us a call or looking at some of our other videos as we go into those further. One of the other things I wanted to cover outside of just asset allocation and where our money sits is one of the biggest impacts to retirement is a fixed income, as I mentioned earlier. A lot of us out there, I have a story about a family member of mine. Her husband retired from the railroad. She got $2,000 a month in the late 80s, right? It wasn't a bad income in the late 80s. Well, fast forward to the mid 2000s, she was getting now adjusted for inflation like $2,800 a month. It never adjusted quite like she needed it to. And long story short, right, that $2,000 a month in the late 80s was not enough to barely get her by into the mid 2000s. So it's something when you're structuring an income plan. I'm a big believer when we're sitting with clients, depending on asset size, depending on what we have to work with, I'm a big believer in kind of laddering strategies or looking at ways to, I call it unrolling some income at those later years. If we turn all our money on at one time and it's $100,000 a year, that's great. But what is our inflation protection down the road? What if in a couple of years we need 110,000? Where are we going to pull from? What are we going to utilize? So I think it's really important when constructing a good income plan to look at laddering some income in there or unrolling some income at certain periods of time. Now that could be done with Social Security, right? Maybe you take yours at one age, your wife takes hers in 2 years, all right, or 3 years, or however long it is, or pensions. I have some clients will turn them on at this age and then turn them on at that age, as well as we could utilize assets. So some of us have some 401ks and IRAs that we're going to turn into income, maybe through the market, maybe we're withdrawing from those assets and have an income plan. And then maybe we're laddering in some annuity payments. A lot of you guys out there know that we tend to use sometimes for clients fixed index annuities that can provide cash flow for life for clients. So even with those, I'll have a client that maybe is taking Social Security at 62. The wife is maybe taking it at 65. And then they're going to start their annuity payment at age 68, right? So you see every couple of years, they have an income increase. I think that's super important when you're looking at a financial plan. Of course, if we have the assets to work with, that's the best way to do it, to strategize income coming in at different times, as well as there actually is some annuity companies out there now that are offering increasing income. That has become a huge topic of conversation, again, with our clients, where we're looking around trying to get income higher in later years because, again, this inflation keeps coming up and up and up. So we're looking at ways to combat it not only this year, but in 4 and 5 and 10 years down the road, just in case. We don't think it's going to stay this high, but inflation will be around to some extent. So it's very important when you're looking at the income plan, you're looking at factors like that, as well as even with your market money or other assets. I have some clients where we're utilizing some of it now. We have some of it sitting in bucket strategies, we'll call it, where we're looking further down the road to unveil that, maybe in 3 or 4 years to level out some extra income. So it's very important you look at different strategies. I wanted to show you one of the clients we've been working with recently where we were able to construct what I was just talking about and unrolling those levels of income for this client. It shows you right here, retired. Client wanted a little over $110,000 per year at this retirement. And then we were able in the next slide to project it out when he was now getting ready to pass away in his late 90s, that his income was adjusted for inflation all those years with pensions, annuities, market money, and Social Security by unrolling those at different times, as well as he actually did have that increasing annuity payment on there, as you guys can probably tell from the picture. But I think it's very important when you're looking at your income and your assets to understand the impacts on all those during inflationary times and making sure you're best situated for whatever comes next. I hope you guys found that video insightful. For those of you that haven't, again, check out some of our other videos and go ahead and click subscribe. And if you haven't yet, check out our radio show. I'm sure you'll get some value from that. I look forward to seeing you guys on the next video.